This is the Net Group Investments Insights Podcast, where one or more of our experts explore a variety of views and insights that investors care about.
Hello, I'm Timisha Greater from Net Group Investments Multi-Management. This installment of your market and economic wrap is titled Reading the Signals, Markets, Metals and Monetary Policy. Global markets start the week grappling with a mix of strong earnings momentum, elevated equity valuations, a surging gold price, and shifting currency dynamics. In the United States, attention is squarely on earnings, with more than 90 S&P 500 companies reporting this week, including Apple, Meta, and Microsoft. So far, the earnings season has been encouraging, with roughly 3/4 of companies beating expectations. Despite growing concern around stressed US equity valuations, in a recent note, Goldman Sachs believes higher multiples are partly justified and argues that the US economy has become more technologically driven and service-orientated, which has resulted in far less volatile growth. According to Goldman Sachs, the economy has spent 8% of the time in recession since 1992, compared with 19% before then. With that said, while innovation remains real, current prices assume near-perfect execution and sustained expansion, conditions that rarely persist indefinitely. Market leadership has become highly concentrated in a small group of mega-cap technology stocks. This has left investors increasingly exposed should sentiment towards that single theme shift. This concentration risk is one of the key forces supporting the rally in gold, which has now breached the $5,000 per ounce level. Gold strength reflects a broader reassessment within global portfolios, particularly as recent equity returns have become heavily dependent on a narrow set of US mega-cap stocks. Investors are increasingly seeking returns with assets that are less correlated to earnings growth, valuation multiples, and US dollar movements. Gold continues to draw support from central bank buying, persistent geopolitical risks, and renewed trade tensions that continue to reinforce gold's role as a hedge. Over the weekend, President Trump threatened to impose sharply higher tariffs on Canadian goods should Canada pursue trade agreements with China. A reminder that geopolitical uncertainty remains elevated. South African equities continue to benefit from this backdrop. Their JSE was supported by ongoing strength in resource counters, particularly gold miners, which remain key contributors to overall market performance. Foreign investor sentiment has also improved. Last week, offshore investors were net buyers of local equities, with inflows of around $38 million on Friday, taking total weekly inflows to more than $300 million. Buying interest was concentrated in gold and industrial counters, while technology stocks remained a source of outflows. In yesterday's trading session, the all-share index jumped more than 1%, bringing its gain this year to around 7%. Precious metals and mining stocks led the advance as gold passed that $5,000 an ounce for the first time. Platinum and silver also reached record highs. Earlier in the day, Asian Pacific markets traded mixed as investors assessed ongoing geopolitical concerns. European stocks were higher in yesterday's trading session as well, and on Wall Street, major indices were in the green as market participants monitored political developments and braced for a busy week of key earnings report as well as US monetary policy meetings. Meanwhile, the rand strengthened below 16 rand against the US dollar for the first time since 2022, boosting prospects of lower inflation and interest rates. On a trade-weighted basis, the rand has strengthened by more than 2% in January, following a solid recovery through 2025. Gains have been most pronounced against a weaker US dollar. A combination of continued dollar softness, surging precious metal prices, and strengthening domestic fundamentals has underpinned the rand's resilience. However, valuation models suggest the window to remain aggressively bullish is narrowing, and US dollar ZAR approaches the 16 rand level. The currency is moving closer to historically extreme strength relative to fair value, which now lies closer to the 17 rand to 17 rand 30 range. Historically, such periods of rand strength have been difficult to sustain, highlighting the need for caution when extrapolating further gains. On the US dollar, while near-term softness persists, its structural dominance remains. The dollar still accounts for close to 60% of global allocated reserves. What is evolving is not so much whether the dollar dominates, but how it is complemented, with incremental diversification acting as risk management rather than a regime shift. Finally, attention this week turns to monetary policy, with interest rate decisions expected from the US Fed, the Bank of Canada, and Brazil's central bank. Markets expect all three to remain on hold as policymakers balance cooling growth against still sticky inflation dynamics. Locally, guidance from the South African Reserve Bank will also be closely watched as investors continue to weigh improving domestic fundamentals against a complex global backdrop. We have come to the end of our note. Until next time, do take care from the Multi-Management team.
This podcast is for marketing purposes only. The information contained in the podcast or video was for information purposes and does not constitute advice, recommendation, or an offer or solicitation to purchase or sell any funds or strategies to any person in any jurisdiction in which the offer, recommendation, or solicitation to purchase would be unlawful.